going to start now about the day 4 of the financial literacy, where we are just exploring about the financial literacy, what it is. We learn about the financial literacy aspect with respect to the credit and debit and credit. This is very misunderstood concept. What I find out that this is just about the flow of the transaction, and debit and credit shows that how the transaction is flowing. We already covered in detail. So this picture which you are able to see will help you in identifying if there is entry in your accounts, so of a transaction. So which thing you have to put in the debit column and which thing you have to put in the credit column. So yeah, if you don't have the idea about it, I would recommend to see my day 3 video. Yep. So yeah, hopefully it will make you understand. Okay, so I think that let's move on and okay. Yeah, let's move on and see where we are. It's still confusing me a lot. As you can see that what's happening here. Oh, I can see if I am live. Yeah, I think so. Live. Just wait a minute. Live channels. So there you go. Uh, okay, so we just understood what it is and the debit stuff. Uh, there are some examples we have already explored, but this is still sets my mind. So it is still a question mark for me as well. So we just stop here. Let's explore what it is and what- here. So as it increases, we already get the debit and credit just told us about the flow of the transaction. So the starting point of the transactions come under the credit and the ending point come under the debit. So if the asset going to increase, then the asset is the ending point of the transaction. So ending point going to be represented by the debit. That's why it has the debit asset, and it's the ending point. Okay, add something valuable type of sim. It means that when there is a relationship regarding the transaction, then which type of section of the item is going to change and in what respect. So that's the thing. Asset decreases means that asset is giving away the value. So the asset is the starting point of the transaction. It is giving away something to something else. So that's why it is a starting point of the transaction. So credit asset liability increases. So there's the confusion rises, I think so. Liability increases. If liability going to increase, if something increase, so it is taking something. So it seems like it is the ending point of the transaction, but it says that it is derivative liability. As per my understanding, it has to be in derivative liability, because if something is increasing, the liability is increasing, we are borrowing something, then it seems like the ending point of the transaction, and it has to debit. But exactly, uh, there's a confusion for me as well why it is credit here. But we will explore more about it. Okay, liability decreases if we pay that a debit liability. Okay, what we did, we decrease we repaid the debt, so the amount goes away from our side, and it's still, I think so. It has to be credit here, because the liability section is increasing or giving away the value, so it has to be like credit. But it says that it is debit liability. Might be my understanding have to be great, but yeah, what it is. Equity increases, same about this one, and same confusion is still remaining for me. Okay, and okay, so let's wait a minute. Wait a minute. So I have to do something. Okay. S- Is okay. However, what I'm seeing here is this uh, uh, debits are value coming into your business. Yeah, the ending of the transaction. Got it? Okay, value coming into your business. Credits are value leaving or own out, loans, income, equity. Each transaction affects at least one debit and one credit. So the balance sheet equation never breaks. It seems like that as we move again towards this one, okay, there's like a confusion for me here. It seems it says each transaction affect, okay, I got it. For understanding debits means value coming in the business. Credits means value going away from the business. So if we are crediting someone, then we are interesting them, so we are giving away something. So here we can see that if liability increasing, then value of the owner, uh, okay. So I have to ask about it. Why it is like this thing? Value. I got this point that it says that debits are value coming into your business, credits are value leaving or out. It seems like the transaction happening with respect to the value. If business, if if I go and make another paint picture or get the same one and edit it. Mhm. Okay, so okay, I will show you the picture, but complete this one. Uh, Visualize in words as a debit side and receivables. So cash, equipment, receivables. So these comes under the asset because it represent the value the business contain. Liabilities and plus equities, like loans, what we have to pay, such as the inventory, we just borrow and say that we will pay once we get paid from the customer on some minimum capital. So these come in the liabilities and equity. Debits increase the left side, credits increase the right side. So it's the right side and it's the left side. So we are seeing this on because you can just make it like uh, adjacent to each other. Well, final equation check after all transaction. Asset, okay, yeah, that's what you mentioned. But my problem is this one. Why the if liability increasing, then the overall business value is increasing. Yeah, the assets are increasing. However, the problem here is this uh, credit liability is making the issue. So I have to understand much more about it. Why? Uh, if the credit and debit showing the transaction flow, then if liability is increasing, means that the value coming into the business, then the liability is the end destination of the transaction, then why it isn't like debit liability. So that's the case. There's a problem. There's my confusion. And yeah, it's too slow. Okay, there's a place for level. Okay, yeah, thank you for flattering me. And let's slow down. It's okay. So, so my understanding was wrong then, if that's the case. Let's slow this down carefully because you're absolutely right to ask if liability brings value money in, why isn't it fitting today? This is the first trap everyone falls into. So I thought, yeah, debit and credit do not mean money coming or going out. They mean instead of the equation, the account lives on, not the cash direction. Okay, not the cash direction. Mhm. What it is, they mean which side of the equation the account lives on, not the cash direction. Account type, assets, normal side debit. Why? They represent resources you own. Mm, okay. Here, it's also making a confusion with the which side liabilities, credit. They represent resources you own. Okay. Like if I am getting, um, if there is a value, however, there's no value. They represent resources you owe, equity, credit. Owner's claim is on the same side as obligations. Expenses debit, they consume equity and reduce it. Yep. Income credit, uh, they mean which side of the equation the account payment. So these are the account type and where they have to live on. They increase equity. So the side debit or credit is based on the position in the balance equation, not the physical movement of the money. Mhm. The balance equation defines the logic to keep this equality true. When assets increase, you debit them. To balance that, something on the right side must increase too, since they live on the credit side. That's why liabilities increases with the credit. It's more about the balancing that balance sheet equation, not about the flow of the transaction. Example, you take a loan of 5,000 cash asset 5,000. Then loan payable liability, 5,000 liability increases credit. Okay. Uh, Loan payable. So we take a loan. Uh, so that money comes from the loan. So in this way, it's a starting point of the transaction, and the other cash as it is increasing the cash. There's the ending point of the transaction. So that's why it is coming here. That's my first understanding. And it says there it is not telling about the direction of the new transaction. However, what I am understanding here is it is more about balancing the equation with debit and credit stuff. So if something is debit here, then it has to be credit here. And if something is credit here, then it has to be debit here. Oops, yeah. I means that um, if, if something is credit here, then it has to debit here and or vice versa. That's it. Okay. Liability. You receive value, cash, debit. You incurred obligation, loan credit. Okay. If you try to debit both, the equation would break. Yeah. Why? Asset increase by this one. Liabilities increase if debited. Left side equation. Okay. If debit means uh, by crediting liability, the equation stays perfect. While liability lives on the credit side, let's see the philosophical meaning. When liability increases, you receive value now. Okay, yeah, from someone else. You promise to return value later. You owe them. So from your company's point of view, you receive the value, debit, asset increase. You promise to give back. There's credit because the promise is trust from others. The credit is the truest Latin word, gratitude to represent trust. Okay, so hence credit liability. This is still spinning my mind. Okay, banks gives you 5,000 loan, debit cash, and credit loan is like 5,000. Yeah, it's credit because it's the loan trusted bank trusted on us, and we said that yeah, we will going to pay this amount. Money flows in, but responsibility flows out. Okay, debit shows what you received, credit shows what you owe for receiving it. Okay, did the business gain control of something? Yes, debit that thing. Did the business become obligated to someone? Credit that liability. Did the business return or pay off an obligation? Yes, debit the liability to reduce it. So you are 100% right that money comes in when liabilities increases. Yeah, but the liability account itself doesn't represent the inflow. It represents the source of that inflow. In short, debit what your business received, credit where that value came from. Yeah, that's the thing about the transaction view. Uh, when a liability increases, it's not your destination, it's your source of funds. Okay, okay, I'm getting something that it's more about here when liability increasing, the setting saying that it it's the end of the transaction. It's like the starting of the transaction. So if liability increases, so I increase liability, then I took the loan, okay, but where it is going to land into my business. So that's why that the liability account or the liability row is representing the starting point of the transaction, but the ending point of the transaction is the asset, which is being debited when liability credit. So in this way, it's making some sense. Okay, I will try to make sense for you as well, but let me first make it sense for me. Okay, and but what about the okay? If the liability decreases, it means that we paid that amount from our assets. It can be from revenue or something like that. So what is going to happen is that our asset going to decrease. It means that our assets going to credit, and when liability decreases, liability going to debit because it's the ending point of the transaction. No, yes, yes. It's the ending point of the transaction. So when the asset re- decreases, it giving away the value. So it is credit asset. And if it is giving away the value or repaying the liability, then it means that the liability have to credit when and the liability going to decrease because it is going to be repaid. In this way, let me see if my understanding is right. I really sucks here. Okay, repay that. Le- my asset decreases. I give away or use the cash. So it means that if there is a loan, I repay it from my assets. Okay, so it is going to decrease. It is going to decrease, and it seems it is going to be credit, right? And liability also going to decrease, which was I repaid it, then it is debit. Yeah, okay, 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 okay. So that's what it is. It is just showing the transaction between this equation. If one side it is going to debit, like this one, this equation. If this side credit, then then there have to be a change of debit and or vice versa. So there's the key point here. Okay, okay. Yeah. Now, okay. Let me show you with the screen as well what I understood with it. But what about the equity? Let me if if it's credit, then it is going to be debit. So if someone I am the owner of the business, so business is uh is a separate entity than me. Okay. And I am the owner or the founder of the business. So if I am giving something to the business, it going to increase my equity. So it will going to increase this side. So if I'm going to deposit money into the business, it is going to increase that part of the business because I'm not giving away the loan to the business, which I have to repay, but I am hoping that I am paying that amount to have a share in the business. So, as an investor or the equity holder, so if this is the case, what is going to happen is that I am going to then this side we is going to uh, increase, okay, but also the asset increase, okay, as per the equation. But how we have to account the transaction? Asset increasing, owner's equity will come in the credit, equity increases, asset increases, okay. So equity increases going to credit and asset increasing going to debit because it is the ending the uh, other side of the equation. So if it is increasing the equity, so from here our transaction is started and equity increases. So equity going to be credit and then the ending point is the asset of the transaction. So the asset going to increase, which is going to debit. So let's see if my understanding is right or still I really sucks here. So equity increases, owner investor earn profit, yeah, credit we put into the business, so equity increases. So where it is going to land? It's land into the asset. It asset increase it is going to be debit. Yup, 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 yo. Okay, if it is going to decrease, what is happening here? I'm not saying this table now. If I have to go here. Okay. If equity increases, sorry, it decreases. I take out the money from the business. So asset going to decrease. So this equity decrease going to be paid by from asset, yep, from the cash, I can say that. So if equity decreases, the asset going to decrease as well. But how we are going to record this thing? So asset paying the owner or the person as a cash out from the business. So it's like they are interesting or they are the starting point of the transaction. So asset going to credit because it is paying out and the equity side taking the payment. So but it is decreasing uh, because we are taking out the money from the business, so the owner's equity is also decreasing. It means that the then equity side going to credit, no, going to debit. Okay, it is decreasing because it is paying out, but what is happening is that asset is paying out. So this is the asset is the starting point of the transaction. That's why it is taking the value in the accounts under the credit, and the ending point of the transaction is the equity. So then the record will go for the equity is in the debit. However, with this whole transaction, there is a decrease in asset and it comes from the decrease of the equity. So yeah, that's the case. So if even if the equity decreases, then it's going to debit. No, it's really making sense for me. Now it's making sense for me. I think so. I am from being stupid and becoming wise a little bit. So, yep, it's great. First of all, to become wise, we have to accept our stupidity. I'm stupid. Yep, I'm stupid at first, but I try to reduce this stupidity or lack of knowledge by understanding the concept. Okay, so that's the interesting thing, and it's really confusing because what is happening is that we have to see the flow of the transaction, but also with respect to this equation as well. Okay, so yeah, let me show you this understanding here. What it is, I'm going to show you a screen, and I'm going to draw something for you. I'm going to draw something for you. That's the transaction visualization we did regarding where we have to put the credit and debit or what we have to do. But now the confusion here is this table. Okay. Which table? Yep. And let me share you this screen. Uh, where it is. Yeah, aja, 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 aja. Yep, there's one. If you have any question, feel free to ask. And if I don't know, I will let you know that. Okay, so here it is. First of all, we get this the idea of this one, which is this. It is done. I think so. As it increases. So what's happening is that the debit asset it's the end of the transaction. Okay, and that's why it is increasing. Debit increases, so it's the start. It is giving away the money. So it is that number going to come under the credit column. Okay, but going uh from, and it is going from this or this one. Okay, but that will not confuse you. Now liability increases. What we here is the confusion. If liability increases, we think that the money comes into the liability, but actually the liability is just showing that how the asset is increasing. Because in the end, um, if liability increasing, it means that money coming in, but it is landing into the asset, so it is increasing the. If liability increasing, the asset is also increasing. So that's the connection between this thing. We can see that liability increasing. So it's the starting point of the transaction. So that's why it, it is the credit. But the asset are also increasing. Okay, asset are also increasing here. Let me do this. Asset are also increasing here because some we are taking loan. So this is increasing the asset as well, but it is also increasing the um, it is also increasing the liability as well. And these are equating in this way. So that's the starting point of the transaction. Liability is the starting point of the transaction. That's why it is coming under the credit. And the ending point of the transaction is the asset because eventually it is landing in our asset of the business. That's why the asset is increasing. And here it is basically saying that if a money, if money coming in the business, then It would come from two things, by increasing liabilities or increasing the equity. So that's thing it is explaining in this. Yes. So what's the confusion now? I think I get the understanding, but I'm unable to explain in much better way. This means that I have to understand it more and more and better way. Okay, so here it is. Liability decreases. What's happening is that if liability going to decrease, it is going to decrease the asset because this liability going to be paid by the asset. So asset going to be the starting point of the transaction. So asset increases, it means that asset going to be credit. Okay. And it is decreasing the liability in exchange. Okay. So if the transaction starting point is the asset, then the ending point is the liability because the asset paying to the liability or repaying the loan. So it is the liability side is the ending part of the transaction. So that's why debit liability. Uh, yep. Okay, if we are going to understand this concept, we have to combine the transaction visualization, the flow, and also this equation. Then we'll know that how the debit credit pair keeps the equation in check. Okay, so because if asset is increasing, it is increased by the liability or the equity. Uh, that's the thing, and the debit credit it's like saying that from where money is coming and from and where the money is lending. So that's the thing. Let me, I think so I have to stop here or what I have to do. If you have any question, guys, feel free to ask. Uh, should I go in depth into this concept or not? I think so I should go because we have much more other concept as well, which we have to talk. But I think so this should be understood. Let me open the Excel sheet and where I will try to explain what really my understanding with this concept because it is hard to draw the things here. I think so I have to do this in my sheet. Uh, in conclusion, we can say that if we are going to understand about the where uh, where we have to record the transaction and how we have to record the transaction, we have to know two things. One thing is the transaction flow, and second thing is the balance sheet equation. Then we can record them properly. Yep. Financial. Hmm. 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 Yep. There's workbook. Workbook. Okay. Okay. Now, let's see. Workbook. So, workbook. Uh-huh. Okay, got it. Now we have this workbook. Here we explore this one. And here we are doing debit, credit, loans. You can see that. So here we go. Here, the equation. Assets equal. It is asset or assets. Yes, assets. Assets equals to liabilities plus equity. So we have to record the transaction. Okay, so here we go. We can put the equation here. So here. Now I have to record the transaction, like what happened. This is transaction detail. And in detail, I so I I deposit $10,000 in my business. Okay, so what's going to happen here? It is asset, asset, liabilities, equity, and how we have how we are going to record it. Well, we can say that it is credit debit. Uh, okay, so I have to put it here. No, I am just making it more confusing. Let me start from simple. Okay, if I deposit 10,000 in my business, so it is going to increase increase equity. Then it's going to also increase the asset, increase asset. Got it? And here's the starting point of the transaction. Okay, because it's the starting point of the transaction. So what I'm going to do, if I'm going to have this one here, okay, and what is here, I put it like which damn it, that sucks first. I'm not good at making the tables, but good to understand. In this case, what is happening? I deposit 10,000 in my business, that increase the equity, this increase the asset. So from where it is starting? It is starting from here. The foundation is starting from here. It is like this one. My equity increases, that graduates, and it is running here. So here it is just doing this thing. So in this transaction details, what happens is that I deposited the amount here, say people credit debit. So that's the entry, and credit debit tell us about from where the money comes from and where the money landed. So it comes from equity and it landed into the asset. Now, okay, there is another transaction. I took loan of I took loan of five 5,000. Okay. So what's going to happen is that it's going to increase my asset, the value my business contain, but it also increase the liability. Okay. And as per the recording, okay, I would say that okay, this money comes from here. There's the starting point of the transaction. So I have to record this 5,000 under the liabilities, but with respect to the credit, because that amount source is 5,000 uh, $5,000 source is the liability, and where it get landed under the asset. So I took note of this one. It increases. Interestingly, what I'm confusing that if liability increasing, then it is the amount is landing in the liability. No, it is telling the source of the credit, tell us the source of funds value. Okay, debit means receiver of funds or value. So that's the main thing. Okay, source is credit characteristic. You can say that credit is the feature or the it tells us the it's the feature of the transaction from where it is coming, from where it is ending. So that's how it is. And if I say that I repaid the loan. Okay, I would say that I repaid the loan. Okay, okay. Decrease. Let, let me. I repaid $2,000 in the to the bank. Okay. So what is going to happen there? The liability decrease by 2,000. Okay. And I repaid that amount with this from my assets, then my asset going to decrease by 2,000 as well, because that repayment is being done from my assets. And so the starting point, the source of fund is assets. Okay, okay. Sorry. And here the end, uh, who is the receiver of the fund is the liability. So here we go. The bank received the fund, so that's why it is coming here. So if you can say that I owner cash out cash out $1,000 from business, then what is happening is this. What is happening? Uh, so that effect. Yeah. Now, uh, so what's happening is that I'm cashing out the amount from the business, then what is going to happen is that my equity in the business going to decrease by $1,000. Okay, but from where that funds come from? They come from assets. So assets going to decrease by $1,000. Wow, nice. So here we go. Source of this transaction, source of the fund. Okay, okay. Source of the fund is this one. So 1,000 saying that is here from come from here, and equity going to debit because it's the receiving or the receiver of the funds. Yeah, got it, got it. So that's it, guys. And now, uh, let's have another scenario. Okay, okay. That's going, it is interesting. Increase, uh, okay. I deposited in the business, equity increases, asset increases, liability increases, I repaid it, increases. So then, is there any other scenario where, uh, okay, increase assets, increase equity, uh, increase, there's one scenario, second, third, fourth, and if I go and see that one, equity increase, asset decrease, equity increase. There's a picture I am seeing right now. I think so I have to show you what I am seeing right now. Why this is not showing here. I don't know. Okay, now if we can. Yeah. So which scenario we already done? This one. I think so I have to copy this one, which I already have into the workbook, and then we will see. Uh, uh, so- so- okay, so here it is. What which type of scenario we already done here? It is this one. We increase in asset and increase in asset, increase in equity, increase in asset, going in debit, increase, okay, decrease in asset, decrease in asset, coming in credit. Okay, we are right here. Okay, liability increases, and it is being credited because of the source of the fund, and asset increases, that's the end of the fund. Got it. So we are good here as well. And liability decreases, which is I repay the loan, liability decreases, then it is going to debit. If it decrease debit, oh yeah, got it, guys. And then it is going to decrease here. As it decreases, credit. Oh, now, so we are progressing well. Equity increases, equity increases this one. So it is going to come into the credit. Yep, because there's a source of fund where it is landing into the asset, asset increases. So here equity decreases, equity decreases here. You can see that, and equity decreases here, damn it, and decreases means here's the receiving point, and it is coming from here. So I think so. We cover all of these things. So we got this understanding. hmm hmm And yep, I think so. I have to remove this one. You can see that we haven't started with the perfect stuff, but by the time become a little bit perfect. So in just one, two, three, four type of transaction, we cover all of these ones. Okay. Yeah, guys. Yep. So yeah, now we have that understanding. Um, yep. Yep. Let's see what don't know what is. No, no. I don't want to use the software. Well, but we got this thing converting table. Right? It just sucks. That's the key. Understanding of this point. I think so. We understood this thing very well now, and now we have to restart our fourth thing. What we did, we just go in so much depth into the topic because if we don't know it well, then why we are just looking into it. Okay. Oh yeah, here it is. Come on. Yep, there it is. Your depth understanding value, how ideas become profitable. I think so we have done with this thing or not. Income liabilities. Oh, we are dying at day 4, but here is stick here. So you have to start from here and then go to the here as we can, and then okay, we have to start soon that income statement. However, I got it this thing, and we will resume it after a break. Hopefully, hope you will find it well. So that's a very interesting topic. I really enjoyed it, and hopefully you too. So see you soon, guys. Bye.